If I'm in the group, it's $1,000. I already have it in there.
I want to see if how many people joined the 100, because I would want a bigger impact.
So, well,
I would be amiable to being in a $100 group too. As just 50 is the safe one to me. You know what I mean?
And
I would go with the 100.
You can go with 100. The deal is, understand again, it's debt and it's going to be coming out.
The people cut out of the banking system end up getting cut out of the American dream. It's harder to get a loan to start a business or pay for a house if you can't save. But at lending circles like these, members save together.
Okay, here's Kim and Bobby. We got two more.
Reverend Charles Butler runs this one in Harlem.
We start a new circle each month, sometimes two circles. Since the inception of the program, we have about 350 members. Okay, so that gives us another one. And Kimberly, 50 or 100?
50.
Each month, every member contributes a fixed dollar amount until each gets a payout. At the formation meeting, they decide on the monthly contribution, establish the order of payment, and set the intention of the circle.
Okay, so you guys end up with a $50 group, $500. Thank you. Let's give him a round of applause there.
Known as Susus in West Africa, Tandas in Mexico, and Hues in Asia, these informal savings and lending groups are a fixture in immigrant communities.
It looks like the presentation will be primarily in Spanish, so if anybody needs a translation, please let me know.
The circles have long been used to evade discrimination from banks and financial institutions and avoid predatory and high-interest payday loans.
People who have bank accounts, people who have savings accounts, nonetheless prefer and find it easier to save in a lending circle or a savings club.
Professor Jonathan Murdoch tracked 235 low and moderate income American households for a year to collect detailed data on how families manage.
Often they say, I've got a community around me, I've got social support. I'm letting them down if I don't make my weekly or monthly contribution. There was one guy I was talking to here in Queens, and he said, this is sacred. This is sacred. I will not eat rather than miss payments. This is a real obligation I have. So it's very meaningful in ways that, if you just got a bank account, you don't have any of that attachment or feeling or obligation.
That feeling of obligation can help members build up credit, or establish it to begin with. Some belong to the estimated 45 million Americans known as the credit invisible, who have no credit history at the three major reporting agencies.
Banks really aren't focused on this population. They're mostly focused on customers who have more money and who are going to be more profitable for the bank, at least in the short run. Investing in customers who are going to be profitable customers in the long run is a lower priority for a lot of banks.
There are also other reasons people find it difficult to build credit in the US.
I think both as a trans person and as an immigrant, I had my own fears of engaging with banks because of immigration status, because of my name not being reflected accurately on my bank account and different financial documents. They've clearly not done a ton for our communities, right? So when I moved here for the first time, I learned suddenly that I needed a credit score in order to access an apartment. And I had no idea what a credit score was. I learned about their program where they support you in the citizenship application financially, and then they also sign you up for a zero interest credit loan to pay off that application and also to build your credit.
The Mission Asset Fund is a San Francisco nonprofit that works to get information to credit bureaus through reporting the repayment of immigration loans and lending circle contributions.
How many of you guys have done or participated in a tanda before? Oh, there's some of you, okay. What we're doing is we're formalizing informality. So we're taking this activity that people are doing already and we're formalizing it. After 12 years of doing lending circles across the country with over 12,000 individuals, our repayment rate is 99.3%. Typically, the financial institutions think about in this segment of clients as very risky. I mean, they have a sense that they're never going to repay back, and because of that, they overprice whatever other loans that they may actually provide for them. But what we're demonstrating with our program is actually people are paying back.
Despite their success, alternative lending practices like Roscas have not expanded beyond immigrant communities.
We found these kinds of arrangements most prevalent, in fact, entirely focused on immigrant communities, not Caucasian communities. It's a big puzzle because they're very helpful, useful, reliable mechanisms for many people, but they tended to be with people who had been using them before they came to the U.S., in Haiti and Bangladesh, wherever they were coming from. They knew how useful they were, and they continue using them here.
Ultimately, Americans still struggle to live outside the financial mainstream even as strides towards accessibility are made. Credit remains key.
Our experience is that whether people like it or not, most people feel they have to be part of the system. Your credit score, your credit record, it's not just determining whether you get a loan or not from the bank. Increasingly, it's determining whether you get an apartment, whether you get a job. And so this credit record, which is tied to being part of the financial system, I think most people see doing well on it matters a lot for all parts of their lives.
All right, so any final questions or anything? All right, good. So that's it. Then I thank you for your time.
Thank you.
Districts like mine, there's always small businesses that are opening up by new immigrants that, and when you look at their books, they have no access, they have no credit, they have no credit history, but how do they get the seed money to open this business?
Ron Kim grew up here and worked in the governor's office during the recession. A few years later, he won a seat in the state assembly, becoming the first Korean American to serve there.
So we're seeing positive outcomes of these type of local lending circles that drive our local economies. And without them, I just don't know how people will be able to get the capital that they need to start a new business or pay for whatever household needs without relying on predatory lenders, online lenders, and other companies that charge ridiculous interest rates and put people in a lifetime of debt. And that is not the direction we want to go.
The unbanked are more likely to be low income, less educated, or belong to a racial or ethnic minority group. That can be an odd advantage when conventional banks fail.
There's a lot of stereotyping going on about Asian Americans, but when you really study what happened, you start to understand why we were resilient during those times of economic distress. When everything was failing, we had our own banking system. We were cash heavy. When real estate became cheaper, all of a sudden we saw people coming out with cash from nowhere and buying up buildings and buying up houses because they realized everything is cheaper and now they have cash, interest rate is like zero, and that's when they start investing. So we almost, without knowing, unknowingly, because of our own kind of cultural resilience towards economics, hacked the system by accident during these moments. But instead of just writing it off, saying as, oh, these are hardworking workers and they're entrepreneurs, we should really study the culture and the models that they adopted during those times of distress and try to scale that up and learn and adopt some of those models. 80% of us, of New Yorkers, are living paycheck to paycheck. All of us believe credit is real money at this point. Wages have been stagnant for 70 years. 7% increase in wages, 70 years. That's pretty much stagnant. Meanwhile, as humans, as workers, we're 80% more productive in 70 years. So what that means is that we're working so much harder, we're much more efficient at our jobs, but all the money, all the profits are going to the top, right? Top 1%. We hear it from Bernie all the time, right? But that means that we're not getting the type of circulation of wealth, and we rely on interest-bearing loans and credit as real money. So if for every dollar that we have in our pocket of real money, that dollar is being leveraged like 10 times over. And we're borrowing $10 of interest on that dollar. So sooner or later, like all that stuff is gonna come crashing. We're just living on borrowed time.
In December 2019, Kim proposed a way to avoid the kind of fees and processing payments that go to third parties when New Yorkers spend on public transit, groceries, or childcare. His inclusive value ledger would put $55.7 billion in public benefits and tax credits onto a free public platform that he compares to a kind of PayPal or Venmo for all.
I'm really trying to advance further the technologies that will bring the next wave of bringing more resiliency, not just lending circles, but being able to, for one-on-one, peer-to-peer, to start transacting and exchange as much value between people at the very local level. If you have SNAP, if you have earned income tax credit, you know how much money you're getting at the end of the year, you know how much money you can spend, but sometimes it's very rigid and there's a huge bureaucracy for you to get $100 to spend on apples and oranges, you know? Maybe you don't need apples and oranges, you know, maybe you need to apply that benefit into paying for a nurse, paying for a care work, you know, a tutor for your child, whatever it is. We can actually create a public payment platform where people can exchange those benefits to everyday needs. Now we're injecting billions and billions of dollars toward the care sector, toward peer-to-peer economies, and local commerce who desperately need new money to save small businesses.
You know, finances is one thing, you know, but people are a lot more complicated than that. Latinos, immigrants, you know, poor people are not, you know, this what conventional wisdom have us to think as being, you know, lazy or broken or just ignorant or that somehow poverty is like our fault, or somehow like, you know, we're in that situation because of what the bad decisions we made, or because we weren't, you know, manage our money well enough, or we weren't saving enough, or we weren't doing something enough to allow us to get out of that situation. You know, having lived that experience myself, I knew that wasn't the case for us. And so with this position, I wanted to sort of demonstrate that, you know, that conventional wisdom of poor people is not true. You know, there's people are hardworking, people are struggling, yes. You know, the real, you know, poverty is a real issue in people's lives. You know, but just because of that doesn't mean that they're broken people. That doesn't mean that they're lazy people. So the idea of families helping each other, working together, you know, despite being undocumented, despite being, you know, pushed to the sides, or despite just, you know, having the world against them, you know, people working with each other. You know, people's financial insecurity, you know, many a times it's actually due because of their political situation, because of their legal status, or because of other things that have nothing to do whether or not they can balance a checkbook or nothing. The first question we get asked from people is like, well, what happens if Carlos doesn't pay up? What happens to my money? Or what happens if John doesn't, you know, just walks away from it? And so that's the first question asked. It should be, right? Because there definitely is a risk that comes with this particular product. So in the promissory note, we say, you know, as long as you pay, you know, your payments, we promise to pay, you know, the full amount, you know, when it's your turn. And so that's sort of like our guarantee of the program itself. The way I explain that is sort of like, is how the, you know, FDIC insures people's cash in their checking accounts, regardless of what, you know, bank they might be checking with. The government has created a program to actually insure up to $250,000 of their money, right? And that way that gives everybody a peace of mind that their money in that checking account will be there for, you know, when they need it, regardless of what happens with that bank. And so that peace of mind is what we're sort of providing, you know, people that participate in the lending circle, to say like, look, through this regulated, formalized program, because we're going to guarantee the, you know, the payout, you know, you know, that should give them peace of mind to participate. After 12 years of doing lending circles across the country with, you know, over 12,000 individuals, our repayment rate is 99.3%. What that means is about 0.7% are the ones that default. They're the ones that we have to cover their cost. But that compares, you know, the typical micro lending industry. The default rate is more like 15%. So people really are, you know, following through with their commitment to us. And then sometimes like that 0.7% of people that don't repay, is not that they don't want to repay. It's not that, you know, that they're being just mean and walking away. It's just that what we notice is that life happens to them. You know, some of our clients have actually gone deported and they can't pay back, or some people have, you know, other life events happen to them, and it's actually hard for them to sort of, you know, to pay back. So in a sense, is that's actually a good thing. And I don't believe that the world needs another bank, or the world does not need another credit union. You know, what we need is better ways of helping people engage into the financial system, but do so in a way that they're the primary beneficiaries of that, where they get the best rates-based products to fit their lives. And so what we're doing as MAF is training them, preparing them to make that that, to make that possible without us having, to steer them to one bank or one product specifically. But banks are supporting us, as they should, because they are benefiting from our work, nonetheless.